Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Weekly Roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
We are so there, aren't we? We're so professional now.
Finally got it.
Introducing ourselves without needing a single prompt. It's amazing. Now, listen, John, this is our last one of the year. Happy Christmas, everyone, by the way. And there are three things we want to talk about, and we don't want to waste anyone's time or drag it out because I know that you have, I don't know, puddings to put booze in and trees to finish decorating, parties to organize, that kind of thing. So we're going to do this fast. First thing we want to talk about is this acceleration in UK wage growth. Fantastic news for everyone. Anyone who's getting a rise in their real wages. Finally, everyone, this is good news. But John, it comes with a downside, right?
Yeah, so wages went up 5.2% year on year, which is the first time that it's accelerated in over a year. It was much more than the market had expected. It was much more than the Bank of England had expected. And it's good news, as you say, because it means that in real terms, wages are rising at 3% a year, which is all good. Obviously, the labour market data is kind of ropey at the moment. And I think that if you were to take the temperature psychologically, I'm not sure that people feel that it's a strong labour market. But whatever, these are the figures. Here we go.
Well, still 800,000 vacancies out there, right?
Yeah, I mean, the vacancies data, I think, has been honestly screwed up by the existence of things like LinkedIn and all the rest of it. I mean, I think lots of vacancies go online and never, ever come off a line again.
Right.
You know, if you look at what the recruiters have been saying since basically the lockdown bubble point and the kind of post-lockdown bubble, they've all been issuing profit warning after profit warning for about 18 months, maybe even 2 years now. So it's a weird one. But anyway, so those are the figures. And what was really quite interesting was the reaction of the bond market. Because basically investors now went from pricing in 3 interest rate cuts next year. Now bear in mind, whenever we started this year, everyone thought, or the market thought, that the Bank of England rate was going to be below 4% by this point, and it's still up at 4.75%. And now they've started expecting that interest rates are actually not going to be cut back much at all next year, basically because they feel that inflation is kind of out of control, or sorry, not out of control, but higher than expected. And as a result,
more volatile.
Yes.
John, you know how we were going to have a section of this podcast and it was going to be called I Told You So, or We Told You So.
Yeah.
If we had decided to go ahead with that probably terrible idea, we could do an entire podcast now on inflation and interest rates, couldn't we?
We could.
Yeah, so just for the record, everybody, we told you so.
The gilt market reaction yesterday was quite spiky, and I did think to myself, that seems a bit extreme. And so the wee chat with Marcus, a regular guest who's a kind of former bond market guy, and he pointed out there was another big legal decision yesterday. So Guy Hans's investment vehicle had been basically involved in this legal case with the Defence Ministry. The Defence Ministry in 1996 sold a load of houses to a private company and rented them back in what turned out to be a very bad deal.
I remember this.
Yeah, and by this point, Guy Hans's group owns them. Basically, the Defence Ministry said, we want to buy them back. They kind of challenged that. And then yesterday in court, they said, actually, no, you have to sell them. And basically, the government, or the Ministry of Defence, will pay them $6 billion for this portfolio. The way it comes out, it sounds like it's a victory for the government. But actually, when you dig into it a bit more deeply, one of the concerns of Guy Hans's vehicle was that because of new leasehold reform laws, they might actually have to sell the assets for much less than their market value. And as it turned out, they haven't had to do that. And so, to cut to the chase, it basically means that the government's got to come up with $6 billion cash by, January. And while it's going to save the money in the long term as an accounting thing, because it's not going to have to pay rent anymore for these properties, obviously it's another sort of little chunk of money that is going to have to come from somewhere. And it's also another example of how the British legal system is really starting to impinge and interfere and become an investment risk. The point is, if this sort of archaeology of financial, shenanigans and changing rules and retrospective decisions carries on, you can see why investors, particularly global investors, might actually start to feel that all the things that make the UK attractive are not as attractive anymore, and you can't really rely on it anymore. So anyway, that's just something to keep an eye on.
It is. I mean, given we've discussed this before, that one of the reasons that the UK should be attractive is because it's brilliant and business supportive legal system. Not so much. On to somewhere that everyone likes a lot more than they like the UK, the US. We've been looking at the US market for ages and feeling a bit nervous about it, haven't we? Saying, maybe, just maybe it's too expensive. Maybe, just maybe it's too popular. Maybe something will go wrong. And we've just had the Bank of America's latest fund manager survey out, and that is about as gung-ho as it gets. So everyone has very, very low cash holdings. US stock allocations is what people say they're doing as opposed to what they're actually doing, just to be clear. But the US stock allocations are at a record high. Pretty much everyone is expecting great returns from the US market. No one's worried about a global recession. Everyone thinks there's going to be more interest rate cuts, etc. So this is a very bullish, very, very confident survey. Are we convinced?
I think I'm convinced that the contrarian indicators have just lined up so well now at the year end. Actually, I'm going to be absolutely 100% honest here. If we don't see a 10% correction in the S&P 500 in the next 6 months, and if we don't actually, in fact, I would go so far as to say if we don't see a bear market in the Nasdaq by the end of next year, then I will have to get rid of my faith in sentiment indicators altogether. Because honestly, they've just, Trump ringing the bell on the New York Stock Exchange, that's just, you couldn't parody it.
But hang on, to be fair, he did ring that bell, and the market hasn't done so well since, has it?
Well, no, it hasn't, because basically the Dow Jones has fallen for now 9 sessions in a row as we say this, and it started on the 5th of December, which is the day that poor old David Rosenberg, who is a guy that I've followed for years, and is someone who could, I think, fairly be described as a perma-bear on stocks, partly because he's a bond guy, and I know that he would, take offence at that, but I think an objective observer would say that it's not unreasonable to categorise him like that. He's not Albert Edwards, but he's the closest thing you'll get, and he basically capitulated that day, by which I mean he threw in the towel and said, oh well, maybe this AI stuff does mean that we're in a different regime, and of course the market started falling since then. Although one thing I will say is the Nasdaq has continued to go up. So it's the Dow and the S&P to an extent that's come off as well, but the Nasdaq, which obviously is the tech bit, has kept going up.
As you say, there's a kind of a bullish capitulation, isn't there? That pretty much everyone is now saying, well, we don't even really understand why, and times are different, and this isn't a normal business cycle. This is a technology-driven, endless bull market, etc. So sentiment across the board is super bullish, but I'm interested in, we had the brilliant Eddie Ardini on our podcast a while back, and he's one of the biggest bulls of all bulls out there, and even he has begun to say, well, there's a correction coming, a correction in a bull market from his point of view, to be fair, partly because sentiment is so bullish, partly because the breadth of the stock market has been falling. So his numbers say only 30% of S&P 500 companies are beating the index on a year-on-year basis. Moving averages, not quite what they should be. And of course, the cover stories, the story in Barron's, why the stock market could gain another 20% next year. The idea of these cover story indicators being that once these ideas meet the retail audience as a whole, they're probably on their way out. Which, by the way, I don't think is completely fair, but very often bullish magazine covers have been contrarian indicators, right? The other thing he points out, which I do think is interesting, is insider activity. The insider sell buy ratio is very high. So we've got a lot of insiders selling into very strong price gains. Now, that makes sense. If I was an insider and the share price of my company had gone up by 400%, of course I would be selling into it. But nonetheless, the higher that number goes, the more it suggests that insiders are beginning to get a little bit cautious and pulling back. So, there's risk out there, right? A lot of risk.
Yeah, absolutely. I probably fall more with you, Danny, when I'm saying that it's, a 20% correction in Nasdaq these days actually is a correction, is not a devastating bear market. And I can totally see how, this might just be a slip in a longer bull market. I don't have a strong view on that, but yeah, the level of exuberance means that something surely has to come off.
Either something has to happen or we are very, very, very old-fashioned, and it's different this time.
True. Actually, did you see the new craze is for quantum computing now? So all the quantum stocks have shot up.
You know how everyone says that we don't understand Bitcoin because we haven't done the work? That's not true. But I really, really don't understand quantum computing. Do you?
No. But in a parallel universe, I do.
Oh, that's so clever. I don't know how to respond. Listen, listeners. If you could send me and John no more than 2 paragraphs, and when I say paragraphs, I mean no more than 5 sentences in each paragraph, and those sentences cannot have more than 1 clause each, explaining to us how quantum computing works and what it means, we would be extremely grateful, because we don't want to go through another multi-year period of people telling us to educate ourselves and do the work. It's very exhausting. Now, one area that I want to talk about before we go, which is not suffering from extreme positive sentiment, is the investment trust industry in the UK. Now, regular listeners and readers will know that I have a history of sitting on the boards of investment trusts, and I do still sit on the boards of 2 investment trusts, neither of which will be mentioned here, but which you can see in my bio. Now, it turns out that an awful lot of investment trust trading on a discount have an American activist investor sitting on their shareholder list called Saba Capital. And today we have news that this fund manager has requisitioned general meetings at a large group of trusts that they hold larger stakes in. So Bailey Gifford US Growth Trust, Edinburgh Worldwide, Keystone Positive Change, Henderson Opportunities Trust, European Smaller Companies Trust, and a couple of others. So that's a lot of fairly big name trusts that Saba wants to have meetings for to, as they put it, hold the fund managers to account because of the discounts and, quote, their inability to deliver sufficient shareholder returns. Think about what Saba will want boards to do. They may want them to just go and replace the boards. They may want to put in place more tender offers, so allowing investors to sell their shares back to the company at net asset value, or possibly just to really enhance the share buyback. So there'll be a lot of worried boards out there today, but it's also very interesting because for the investor, if you have been buying investment trusts at large discounts, there's hints here that action has been taken that might close those discounts.
Yeah, I mean, I think if you own these trusts, you would have to see this as a good thing because, I mean, the very fact that Saba was a presence on these trusts' shareholder registers obviously picked up a lot of interest when it first happened. And I think now the fact that they're saying, right, one way or another, these discounts have got to close is really good news for investors and investment trusts because the sector as a whole has been hammered. And, a lot of that, I'm sure, is for reasons out with boards' controls to things like, regulations on cost disclosures and confusion over that. And also generally the flood from active to passive means that investment trusts have been losing out. But equally, I think there's probably things that they could have done that they haven't been doing, and we'll find out if that's the case.
The thing is that, a discount to net asset value is a function, obviously, of supply and demand. And there's been a massive fall off in demand in the investment trust sector, particularly for the smaller trusts, because the mergers in the wealth management business have meant that there's a lot of central lists of what you can buy and what you can't buy. And a wealth manager will need to take a much larger stake in an investment trust than it would have in the past. And that means that the size of investment trust that they can invest in has gone up and up and up. So when I first started hanging around the investment trust industry, it was reasonable to expect that if your trust was worth 300 million, the wealth managers would buy it. And then they went to 400, 500. Now all of the big wealth managers will say, well, we can't realistically invest in a trust unless it's got a market cap of knocking around $1 billion. So that means that demand for the smaller trusts has fallen off partly from that business, partly from the institutions who obviously been moving away from UK listed altogether. And the retail investor, not quite enough of them coming in to make up that demand gap. So that's part of it. And the bigger the discount gets, maybe the worse the eventual return to the shareholder on an annual basis looks, because it's all very well the net asset value going up, i.e. the fund manager performing adequately. But if there's a discount, the shareholder isn't seeing that return. They're seeing the share price, not the net asset value. So, it's a difficult time for the industry. It really is. I mean, this is an industry that's been through an awful lot of difficult times in the past. But this time really is very tough.
It's kind of like a microcosm of the whole UK equity market.
Yeah.
And the government is like a negligent investment trust board.
Absolutely.
Just presiding over a decline, which is caused by factors that it can't directly control, but it's not doing anything about it.
It can do more about it. That is the key thing. And so when you see Saba coming onto these boards, it's generally considered by boards to be a bad thing, because it suggests that the more buybacks will be forced, tender offers will be forced, and that means that the trusts shrink, right? And that threatens their long-term viability altogether. So if you have to keep doing buybacks, and if you have to put up a tender offer, and a lot of shareholders disappear from the register, and you end up with a market cap of 200 million or 250 million or 100 million, what happens? You end up shutting down because you're no longer viable. So in that sense, it does threaten the long-term existence of the investment trust industry in size, which I think is a very bad thing, because they're great long-term investment vehicles and have served investors well for hundreds of years at this point. So losing this sector would be very, very bad. On the other hand, it is also the case that sometimes boards and fund managers also can become complacent, and boards can spend a lot of time asking the fund managers who they hire to run the money on their behalf to, and change the way they invest, or change the way they market, or change various things, and not necessarily get what they want. And then you may also find that there are boards that aren't quite doing what they should do. So in some senses, having an activist like this coming into the market and going, whoa, you guys, you can do better, not necessarily a terrible thing, but it might have consequences for the sector that long term aren't necessarily good for the retail investor. Am I making this sound too complicated?
No, it makes a lot
Swings
of
and roundabouts,
sense.
basically. Swings and roundabouts, John.
Well, I think it's very exciting. At least at this point, it's exciting, and I think it at least will put a rocket up the backside of the sector, and possibly make it just more appealing to get more flows in, because people think, oh, actually, that thing that's on a 20% discount, maybe that's actually going to be realised and narrow at some point in the next 6 months.
Well, interesting. And I did write last week or the week before about the renewable energy investment trusts, some of which are trading on massive discounts. And I know we're a bit down on renewable energy at the moment. Although, by the way, the wind is blowing big time at the moment. So suddenly renewables look great for UK electricity generation. But nonetheless, some of these trusts are really at phenomenal discounts with relatively interesting inflation-linked cash generating assets inside them. So, worth a look. And the entire sector is worth a look if there are these activists coming in to try and shake things up a little.
Sounds good.
Okay, there you go. So there's something expensive and something cheap for Christmas. Anything else, John?
No, I think it's just time to wish our readers a Merry Christmas and a Happy New Year.
Yeah, Merry Christmas and Happy New Year. And to you too, John, by the way.
And you too, Mel.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm Merryn SW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb, was produced by Sam Asadi, production support and sound design by Moses Andam. Want to listen to episodes of Merryn Talks Money ad-free? Become a Bloomberg.com subscriber today. Check out our special intro offer right now at Bloomberg.com/podcast offer, or click the link in the show notes. You'll also unlock deep reporting, data, and analysis from reporters around the world. If you're already a Bloomberg.com subscriber, connect your account within Apple Podcasts to listen to this episode ad-free.